All right, everybody. I'm Logan Alec. I'm a CPA. My team and I help taxpayers resolve their tax issues, whether removing tax liens or submitting offers in compromise or installment agreements. If you want to reach out to me and get a free consultation with me and one of my tax specialists, who's either a CPA like myself or possibly an IRS enrolled agent on my team, you can email me directly at taxrelief@loganalec.com with a few sentences about your situation, how much you owe, why you owe, and we'll take it from there. This video is not tax advice. It is for general informational purposes only. Yes, I am a CPA. I'm a tax professional, but I am not your CPA. I am not your tax professional unless you have, in fact, engaged me in my firm as such. So today, I'm talking about the offer in compromise. This is one of the most popular topics, most popular questions I get from people who owe back taxes to the IRS by far, right? Logan, what's an offer in compromise? Do I qualify for an offer in compromise? How do I do an offer in compromise? These are all great questions. In the coming weeks, I'm going to be publishing multiple videos on the offer in compromise, doing separate videos for each of the 3 different kinds of offers in compromise, walking you through in detail offer in compromise calculations, walking you through the forms, the 433A OIC, the Form 56. If you don't know what those forms are, and I imagine you don't, that's okay. I'm going to walk through them in future videos, but this video right here that you're watching right now, I'm not going to go through the forms in this video. This video is just giving you an overview of what the offer in compromise is and how to qualify for one, because you really need to know that before you actually get into the weeds of filling out those 433A OIC, the Form 656, which I'm going to show you how to do in future videos. I'm also going to be creating videos on other tax relief issues and solutions, such as installment agreements, not just full pay installment agreements, but also partial pay installment agreements, which, by the way, if you're not an offer candidate, you should consider partial pay installment agreements. I'm going to be creating a video on currently non-collectible status just to get the IRS off your back for a couple years, videos on tax liens and levies. So be sure you subscribe to the channel, hit the bell so you don't miss anything. But in this video right now, I'm going to be giving you a 10,000-foot overview of the offer in compromise, specifically what an offer in compromise is, who qualifies for an offer in compromise, the 3 kinds of offers in compromise, how to submit your offer in compromise, what to do if your offer is accepted, what to do if your offer is rejected, and finally answering some frequently asked questions about offers in compromise at the end. Because look, I want to educate you, right? You can do an offer in compromise yourself. You can. A lot of this stuff, especially in the more detailed videos I'm going to release, however, does get a bit complicated. There's a lot of nuance and specialized knowledge and tricks that you really want to know, so you don't end up offering a penny more than you need to the IRS. Because a lot of the times when non-tax professionals submit an offer in compromise, well, either A, they do it wrong and it gets rejected, or B, it gets accepted, right? But they actually offer more than they had to. They don't know they can exclude a portion, the value of their car, right? They don't know these little tricks that they can do to shift stuff around on their personal balance sheet to reduce the amount of their offer to the IRS and still get accepted. All these little tricks. But I want to make sure you're educated on these things, so that if you want to submit an offer in compromise yourself, you can do that. You're empowered to do that. Of course, you can also reach out to me, taxrelief@loganalec.com, if you'd like to have a free consultation with me and one of my CPAs or EAs about your situation to see if we would perhaps be a good fit to work together on your offer in compromise. But that's enough of that. Let's get right into the meat of this video. What is an offer in compromise? An offer in compromise is an agreement between a taxpayer and the IRS that settles a taxpayer's tax liabilities for less than the amount they owe the IRS. This is where the name comes from. You, the taxpayer, are making an offer to compromise with respect to your outstanding tax debt. Now, you might be wondering why an agency as powerful as the IRS would even entertain the notion of collecting less than they are owed. Well, the IRS understands that not all taxpayers will be able to pay their tax debt off in their lifetime. And so they operate under a statute of limitations. I'll tell you what that means later in this video. And they want to give taxpayers the opportunity to get in compliance. Rather than scaring taxpayers, right, and hiding under a rock and disappearing off the face of the earth, which is a lose-lose for both the taxpayer and the IRS would rather be paid what they can get paid, even if it's less than the total amount of tax owed, as soon as they can. So what's the catch? As enticing and as taxpayer-friendly as an offer in compromise sounds, there is, of course, a catch, and that catch is that not all taxpayers who owe the IRS money will qualify for an offer in compromise. So who qualifies for an offer in compromise? Well, the way I like to explain it is that there are two categories of requirements that must be met when it comes to submitting an offer in compromise and getting the IRS to accept it. The first set of requirements I call the baseline requirements. These are the requirements you have to meet in order for the IRS to even consider your offer in compromise in the first place. Meeting these requirements doesn't necessarily mean that the IRS will accept your offer. All it means is that the IRS will review your offer and not return it to you as unprocessable, right? Because if you submit your offer and the IRS receives it and they notice that you haven't met these baseline requirements, they will return your offer to you as unprocessable. They won't even review it because you haven't met these requirements, okay? So let's walk through these baseline requirements to submit an offer. Number one, you must be in compliance with respect to your tax return filings. What does compliant mean in the eyes of the IRS? Does it mean that you must have filed a tax return for every tax year that you had a filing requirement? Now, it used to mean that, but now, thank God, it actually doesn't. According to IRS Policy Statement 5-133, and sometimes you have to remind the IRS about this, but according to the IRS's own policy, tax return compliance only looks at the last 6 years. So right now, in 2021, that means 2020, 2019, 2018, 2017, 2016, and 2015, right? And typically, even if you did not file tax returns beyond 6 years, and you should have, usually it's not in your best interest to go beyond 6 years, right? Just go back 6 years. Otherwise, you may create more trouble for yourself. I'll give you an example from a free consultation I recently had with somebody. The same kind of free consultation you can get just for shooting me an email, taxrelief@loganalec.com. So this individual, who's now a client, by the way, told me that he owes the IRS a lot of money from tax years 2016 and 2017, okay? He filed returns for both of those years. The IRS sent him bills for the tax he owes for those years, okay? He did not file tax returns from 2010 to 2015. IRS never sent a bill for those years either. But when he got his taxes done this year, he was talking to his tax preparer about an offer in compromise. His tax preparer didn't know how to do an offer in compromise, but his tax preparer did know that my client, who was not a client of mine at the time, of course, but the tax preparer did know that my client had to be in compliance with his tax filings in order to do an offer in compromise. So the preparer said, hey, I could prepare your 2010 to 2015 returns for, $500 a pop or whatever to get you in compliance. Client agreed. Tax preparer did that, filed the 2010 to 2015 returns. My now client, paid the tax preparer $3,000 for those tax years. And so my client on the discovery call is very happy. He's very proud of himself that he got himself in compliance, right? He's all in compliance. Now he's ready to take care of his tax debt through an offer in compromise. But then I had to break the news to him. Buddy, you only have to be in compliance back to 2015. So not only did you pay your tax preparer $2,500 or so unnecessarily, but that's not even the worst of it. Because you filed those tax returns from 2010 to 2014, which were not necessary to submit an offer in compromise, now you've awakened a sleeping dog. Now the IRS is going to assess your tax from 2010 through 2014, and now you're on the hook for it. And that 10-year statute of limitations when the IRS can collect from you is going to start from 10 years after the IRS assesses the tax on those returns you just filed, right? That we could have just forgotten about if you hadn't filed those returns. Big oops, right? And there's no takebacks here. You can't tell the IRS, IRS, actually, I want to take those tax returns back. Don't file those. Don't assess the tax, please. Nope, you can't do that. That's why if you're going to do this stuff yourself, you really need to know this stuff, or you could dig yourself into a bigger hole unwittingly, or you could just reach out to me, right? taxrelief@loganalec.com. All right, so baseline requirement number one, you have to be in compliance with respect to your last 6 years of tax returns, okay? Now, before we move on to the other requirements, I do want to talk about one thing, and that one thing is a substitute for return. What does that mean? This is when you haven't filed a tax return, and the IRS does their own calculation of your tax return for you based on third-party information, such as W-2s, 1099s, K-1s, things like that, so that they can determine and assess your tax. And this IRS-generated tax calculation is called a substitute for return, or SFR, okay? Note that for purposes of determining tax return compliance, SFRs count. Okay, if the IRS has filed an SFR for you for a given tax year, you do not have to file a tax year for that year in order to be compliant for that year. Of course, SFRs generally leave out many deductions that would otherwise lower your tax liability for that year. So the question becomes, should you file tax returns for the years that the IRS filed an SFR if doing so would reduce your tax liability for that year? If you're an offer candidate and you're pursuing an offer in compromise, that actually won't help you very much, if at all, because with an offer in compromise, you are settling based on what you can pay, not what you owe. In fact, letting an SFR with a high tax liability stand and not replacing it with a tax return could very well make the IRS more likely to accept your offer, because the high tax liability could give the impression that you will never be able to pay off what you owe, making you a more likely offer candidate, right? All right, let's move on to baseline requirement number 2, estimated taxes compliance. You must be current on your estimated taxes for the current year. I recommend that when you submit your offer, you enclose a copy of the check you used to pay your estimates for the year, along with copies of the estimated tax vouchers if you owe estimated tax for the year. Similar to the tax return compliance requirement, if you are not in compliance with your estimated taxes at the time the IRS receives your offer, they may give you 30 days perhaps to get in compliance with your estimated taxes, but if you don't get in compliance, IRS will return your offer to you as unprocessable. Baseline requirement number 3, you cannot currently be in bankruptcy. If you're in bankruptcy, don't bother filing an offer in compromise. The IRS will simply not consider it, despite the fact that bankruptcy courts have asked the IRS to consider offers in compromise as part of bankruptcy proceedings. The bankruptcy code has an automatic stay on collection, which applies to IRS collection efforts as well. And since the IRS considers an offer in compromise a collection activity, they will not even look at your offer if you're in bankruptcy. They will return it to you as unprocessable and take any money you paid in with your offer, crediting it to your balance due. And finally, baseline requirement number 4, you can't be under audit for any tax year on which you owe a liability. That audit has to be wrapped up before you submit an offer. All right, so those are the baseline requirements to submit an offer in compromise. These should be taken care of before you even submit your offer. If not, and the IRS receives your offer, they will typically give you 30 days to correct these baseline issues, but if you don't correct them, the IRS is going to return your offer to you as unprocessable. Of course, if these baseline issues are taken care of, then the IRS will actually review your offer. And in order to get your offer accepted by the IRS, you have to convince the IRS of one of 3 things, okay? And these are the 3 kinds of offers in compromise. I'm going to list them out here and then go in further detail on each one after I list them out. First kind of offer in compromise is called a doubt as to collectibility offer in compromise. This is the most commonly submitted and accepted kind of offer in compromise. You use Form 656 for this one. Second kind of offer in compromise is called a doubt as to liability offer in compromise. You use Form 656L for this one. Third kind of offer in compromise is called an effective tax administration offer in compromise. You would use Form 656 for this one, same as the doubt as to collectibility offer. Now let's talk about each of these types of offers in turn. Let's start with the doubt as to collectibility offer in compromise. With a doubt as to collectibility offer in compromise, you are showing the IRS, based on their own rules and calculations using Form 433A OIC. Of course, I will do a video in the future specifically how to complete this form. But point is, with the doubt as to collectibility offer in compromise, you're showing the IRS that based on your income and assets, you cannot pay the full amount of your tax debt. Okay? The amount you can pay is known as your reasonable collection potential. Okay, and this is calculated on Form 433 OIC. You're showing the IRS that this reasonable collection potential is less than the amount you owe. And you say, okay, IRS, I will pay you my reasonable collection potential over either 5 or 24 months. In a future video, I'll get into the details and strategies there. But you're going to pay the IRS your reasonable collection potential in settlement for your entire tax debt, which is higher. Now, this video, like I said, is a brief overview of offers in compromise. In the coming weeks, I will be creating a dedicated video on the doubt as to collectibility offer in compromise. How do you calculate your reasonable collection potential and all that? Because there are a lot of nits there. Yes, you can kind of figure it out yourself simply by going through the Form 433A OIC, but that form doesn't tell you all the tricks, doesn't really tell you everything you need to know, so I will be releasing a dedicated video about that. Now, before we move on to the next kind of offer in compromise, I want to talk briefly about something called the streamlined offer in compromise. If you're filing a doubt as to collectibility offer in compromise, you may qualify for a streamlined offer if you make $100,000 a year or less and you owe less than $50,000 to the IRS. Note that this $50,000 figure includes not only taxes, but also penalties and interest. So what's the benefit of a streamlined offer? Well, streamlined offers in compromise are generally subject to far less scrutiny than non-streamlined offers. So this is essentially a time-saving device for the IRS and also a win for taxpayers who owe them. All right, now let's go over the second kind of offer in compromise. That's the doubt as to liability offer in compromise. This is for taxpayers who can show that they do not actually owe the tax the IRS has assessed on them. This may sound far-fetched, but it's important to keep in mind that the IRS does make mistakes. I've seen doubt as to liability offers and compromise accepted for all kinds of reasons. For example, the actual statute of limitations ran out, but the IRS calculated the statute incorrectly, or perhaps the tax was never actually assessed, or the tax was improperly assessed, or the penalty was never actually assessed, or the penalty was incorrectly assessed, or the tax was not actually due, or the tax was actually paid, but the IRS did not post the payment correctly, or the tax had been discharged in bankruptcy, or get this, the IRS was going after the wrong taxpayer. This happens more often than you might think, especially for taxpayers with common names, the John Smiths and James Browns of the world. Now, if the IRS has previously adjudicated your tax liability, that is, the IRS has already explicitly decided that the liability assessed is proper, such as through appeals, for instance, don't bother filing a doubt as to liability offer and compromise in an attempt to get them to change their mind. It's a fool's errand. They will not. I'll be making a dedicated video on this kind of offer and compromise as well, so sit tight on that. Remember, I just want to give a high-level overview in this video right now. Next kind of offer and compromise is the effective tax administration offer and compromise. This is for taxpayers who owe the tax to the IRS. There's no doubt about it. Okay, so they're not eligible for a doubt as to liability offer. And they have the means to pay the full tax due, so they're not eligible for a doubt as to collectibility offer. However, they can show that paying the full amount of their tax liability would expose them to economic hardship, and or there are public policy / equity considerations in play here that undermine public confidence that the tax laws are being administered in a fair and equitable manner if they had to pay their whole tax liability. Basically, the IRS just doesn't want to look bad. Okay? Oftentimes, not always, but oftentimes, effective tax administration offers have to do with some kind of health problem. Sure, you have the $100,000 in the bank to pay off your tax liability that we all agree that you owe, but you need that money to pay for a life-saving surgery or a treatment that your insurance isn't covering. Essentially, the effective tax administration offer and compromise is about the IRS saving face. Okay? They don't want the publicity that comes along with taking money from a taxpayer in a dire, often life-threatening situation, right? They need this life-saving medical treatment or something. Now, this typically takes more than the proverbial doctor's note. You really have to give details here, tell a story, make your case, because effective tax administration offers and compromise require a higher level of approval than the other two kinds of offers. While the other two kinds of offers can be approved by the two IRS offer units, one in Memphis, the other in Holtsville, New York, effective tax administration offers typically need approval from the IRS National Office in Washington, D.C. Now let's just talk briefly about submitting your offer and compromise. Again, I'm going to mention forms here. I know I didn't go over how to fill out the forms in this video, but I will do that in future videos. So after you complete your offer and compromise, and you use Form 656 for that, okay, make sure the Form 656 is signed by you and your spouse, if your spouse is on the offer as well, assuming you file jointly, right? So make sure you sign in Section 8. Obviously, if you're using a professional to prepare your offer, they would sign in Section 9. So first thing in the package you send the IRS is the Form 656 offer and compromise. And this is the contract, right, between you and the IRS. Now, if you're filing a doubt as to liability offer and compromise, you would use Form 656L rather than Form 656. Next form to include in your envelope to the IRS is the Form 433A-OIC. This is the form on which you calculate how much your offer and compromise amount is. Make sure your 433A-OIC is signed in Section 10. Now, if you have a business other than a sole proprietorship, meaning you have an S Corp, a C Corp, even a single member LLC, believe it or not, you would also need to include Form 433B, which calculates your business financial information that then gets carried over to your Form 433A OIC. Do not use Form 433B OIC. Form 433B OIC is for a business that's doing its own offer and compromise, right? But you are doing an offer and compromise for yourself, an individual. So you use Form 433A OIC, and if you have a business, you complete the business information on Form 433B, not Form 433B OIC. I've seen folks make this mistake a lot. Next thing to include in your offer package is your supporting documentation. Now, at the bottom of page 8 of the Form 433A, the IRS tells you what documents to attach: most recent pay stubs, most recent statement for each of your investment and retirement accounts, most recent statement from all other sources of income, copies of 3 months worth of bank statements, copies of 6 months worth of statements for business bank accounts, most recent statement from lenders on all your loans. Those are the big ones. There are some other documents listed on there as well. If you're not sure, I would say don't submit it, right? Let the IRS ask for it. Finally, you need to include your payment with the offer. Okay, the payment with the offer differs based on the kind of offer you're submitting. If you can pay your offer off within 5 months, you have to submit a 20% down payment on your offer. Or the other kind of offer, you can stretch it out to 24 months, okay, but you would have to offer a higher amount than if you were to pay it in 5 months. And with the 24 months, you got to make periodic payments in that. I don't want to get too deep here on the details of these two different kinds of offers and the payments on them. I intend to cover what you need to know about that in a future video on how much you should offer in an offer and compromise. Now, on top of your initial offer payment, you will also need to submit a $205 non-refundable application fee. Now, if you qualify for low income certification, you don't need to send any money in with your offer. There's a table here on screen. Basically, you qualify for low income qualification if your adjusted gross income, as indicated on your most recently filed tax return, that's Form 1040, or if the annualized amount on your of your household's gross monthly income for offer and compromise purposes, 433A OIC, is equal to or lesser than the amount shown in this table here for your family size and location, then you qualify for low income. Okay, so if you live in one of the contiguous 48 states and your family unit has a size of 3 and your income on your most recently filed tax return or your household income for offer and compromise purposes, which could very well include your spouse, by the way. So, if you make $25,000 a year, don't get excited because if your spouse makes 30, you don't qualify, okay? But in this scenario, if your income based on tax return or your offer is $54,300 or less, then you would qualify for low income certification and you don't have to pay any money when you submit your offer. Of course, if your offer is accepted, you would have to pay the amount of your offer, right, over the 5 months or the 24 months. But if the IRS doesn't accept your offer, you haven't paid them anything, as opposed to if you're not low income and you submit an offer and you submit, the required payment with your offer, but then if the IRS rejects your offer and you're not low income, guess what? The IRS keeps that money. It's a non-refundable payment of tax. So this prevents people from just filing offers willy-nilly, right? But if you're low income, you don't have to worry about that. All right, just to recap here, in the envelope you're going to send to the IRS, you have your Form 656, that's the actual contract of your offer and compromise. You have your Form 433A OIC. You have your Form 433B if you own a business other than a sole proprietorship. You have your supporting documentations to support the income and equity. You're reporting on your Form 433A OIC to determine the amount of your offer. And you have your payment. Okay. Now, where do you send your offer and compromise? Well, I have a table for that for you as well. You will send your offer to one of the 2 IRS offer units. One is in Memphis, Tennessee. The other is in Holtsville, New York. They're on Long Island. Which one you send it to depends on which state you live in. For example, if you live in California, you're going to send your offer package to Memphis. But if you live in Michigan, you're going to send your offer package to Holtsville. I'm not going to read all the states out here. You can see them here yourself. Of course, you're free to pause the video here to note which IRS offer processing center applies to your state. Now let's talk about what to do after you submit your offer and compromise. So after you submit your offer, all you can do is wait, right? As well as make your required monthly payments, of course. Eventually, after 6 months to a year on average, the IRS will send you a letter stating that they have either accepted or rejected your offer and compromise. I'll talk about what to do if your offer is rejected in a minute, but if the IRS accepts your offer and compromise, congratulations. The worst is behind you, but there are still some things you have to do so that your offer is not canceled by the IRS. Here they are. Number 1. You must pay the offer amount in accordance with the terms of your offer, either within 5 months for a lump sum cash offer or within 24 months for a periodic payment offer. Again, I'll explain what lump sum cash offer, what periodic payment offer mean in a future video, along with the strategies there. Number 2, you must remain in compliance with the filing and payment of all tax returns for a period of 5 years from the date the offer in compromise is accepted, including any extensions. And this includes estimated tax payments as well. So you have to be a good little taxpayer, right? Ideally longer than this, but for at least 5 years after the acceptance of your offer. If you do not meet these requirements, even after the IRS has accepted your offer will default and you will once again owe the original amount of taxes, penalties, and interest owed, less any amounts you've paid in. Also, unless you submit a doubt as to liability offer, the IRS will keep any tax refund, including interest due to you, for the calendar year in which the IRS accepts your offer and compromise, so you may want to adjust your withholding or whatever you need to do to minimize that tax refund. Note that this refund retained is not considered a payment towards your accepted offer amount. This is on top of your offer amount. Now let's talk about what happens if your offer is rejected. If your offer in compromise is rejected, meaning that your offer was in fact processable by the IRS, you met those baseline requirements I talked about at the beginning of the video, but the IRS reviewed your offer and rejected your offer. What can you do? This warrants a dedicated video in and of itself, what to do if the IRS rejects your offer in compromise. That is on my content plan as well for some point in the future. But let me just list out your options for you here. Most common thing people do is file an administrative appeal using Form 13711 within 30 days from the date on the reject letter. Okay. Another option is to simply submit another offer in compromise, but please make sure it's substantially different, i.e. more than the rejected offer. You could also look at a tax court petition or perhaps go the installment agreement route. And sometimes installment agreements, partial pay installment agreements work almost as well as an offer, right? Especially if it's partial pay in which you're not paying the full amount due. What if you don't hear back from the IRS, right? They don't send you a letter of acceptance or a letter of rejection. Time goes by, you don't hear anything. This is extremely rare. To be honest, I've never had a client where this actually happened. But there is a rule called the deemed acceptance rule that says that the IRS does not return or reject your offer in compromise within 24 months of when you submitted it, it is deemed to be accepted. However, if your tax liability is disputed, the 24-month period doesn't start running until the tax liability is no longer in dispute. All right, folks, so we're coming up on half an hour here for this video. At this point, I've covered all the basics I want to cover in this video. I intend on covering further details in future videos, but now I'm just going to go over some common questions that people generally ask about the offer in compromise, okay? First question. Will the IRS remove an existing lien while an offer in compromise is being processed? The answer to this question is usually no. Unfortunately, most of the time, the IRS will not remove an existing lien while an offer in compromise is being processed. The lien will likely stay in place until the offer is accepted, and then you or the professional you're working with can get the lien removed. If you do nothing, the IRS will likely remove it after you've paid in your entire offer amount. There might be an exception to getting the lien removed before then if you can show that the lien is causing you economic hardship, but this can be pretty difficult to do. Next question. Will the IRS file a new federal tax lien on your property while they are considering your offer in compromise? So, yes, the IRS can technically file a new federal tax lien on your property while they are considering your offer. While the IRS stops collection activity while reviewing your offer, they do not consider the filing of a federal tax lien a collection activity. However, in my experience, in general, the IRS does not actually do this in process, although they can. Next question. I'm currently on an installment agreement with the IRS. When can I stop paying on that after I submit my offer? So you can stop paying on your installment agreement once the IRS has begun reviewing your offer in compromise, which only happens if your offer is actually processable, meaning that you have met those baseline requirements. An offer in compromise stops enforced collection action not when you submit it, but when the IRS deems it processable and can therefore begin reviewing it. However, if the IRS returns your offer to you as unprocessable, you don't get a break on your installment agreement payments. Next question. I'm currently paying on an accepted offer in compromise with the IRS. Can I submit a new offer? The answer to that is yes. If your circumstances have drastically changed, you can submit a new offer in compromise to the IRS to see if they will accept a reduced offer. Next question. Does interest continue to accrue after I submit my offer? The answer is yes. Interest continues to accrue after you submit your offer in compromise. Interest stops accruing on the date the IRS accepts your offer. Next question. How are payments applied in an offer in compromise? Well, when you send in any payments to the IRS, including the one you submit with your offer in compromise, you have the right to designate a payment to the tax year or years of your choosing. If you don't designate your payment to a particular tax year or years, the IRS will designate it however it wants in the best interest of the government. Of course, with an offer in compromise, you typically don't care very much where or how the government designates your payment, since you are settling for the entire amount you owe anyway. And finally, beyond the numbers, are there any factors that could hurt my ability to get an offer in compromise? The answer is yes, there are. The IRS can hold some actions taken by you against you, such as failing to file tax returns or pay tax for a number of years. They generally overlook this, right, as long as you get in compliance under the 6-year rule before submitting your offer. If you deliberately avoided paying tax, you're a tax protester. They can't technically call someone a tax protester anymore, but if you're a tax protester, IRS could hold that against you. All right, folks, that's all I have for you in this video. As you know, I've barely scratched the surface here on what you need to know about offers and compromise. Within the coming weeks and months, I'm going to be releasing a lot more content on this subject. Next video is going to be a video on how much you should offer in compromise to the IRS. I'm going to dig real deep in the numbers in that one. You'll definitely need your calculator for that video. And finally, if you have tax troubles with the IRS or your state, shoot me an email, taxrelief@loganalec.com. Free consultation with me and a tax specialist on my team, either a CPA or an enrolled agent, and we'll take it from there and get you set up if that makes sense for you. Thanks for watching, everybody. Please be sure to check out the other tax videos right here and right down here for more tax knowledge, because knowledge is money, and that is especially true when it comes to dealings with the IRS. I'll see you later, everybody, and I look forward to reading your emails. Bye-bye.